in the quest for triple-digit gains, one tends to ignore the basic golden rules of trading. So let's pause for a moment and relook at them. Now is a good time as any to walk through some of the commandments of technical analysis. And of course, Dr. Narayan has a set of 5 which I forced him to come up with. Tell you the first one that he believes in there, which is believe what you see on the charts. That's number 1. And number 2 is develop the courage to go against the common view. So how does this apply?
Well, charts are indicating to you what is happening in the market real time, right? So you may see patterns on the chart, you may see breakdowns which go fly against what is mostly held as a view by the commoners, right? Like let's take an example of, let's say, Infosys, which is showing you a head and shoulder pattern. We have discussed this on our show earlier. But it's very difficult to believe that the uptrend in Infosys is over. So you need to believe what you see on your charts, you know. It is saying something, believe it and act upon it. Going against the grain is something like everybody said you have a little bit of an upside and then everybody says 6,000 index. Now if you just drop a trend line, resistance trend line, the market is finding it difficult to cross the resistance trend line. Now if you just look at what everybody is saying, and here everybody is saying they're all talking about 59, 60, 6400 on the Nifty. But then where is the market crossing the minimum resistance? So develop the courage to go against the view of the commentaries. That is how you will stick. So that will happen only when you believe what you see.
Right. Point well said. And the other rule is also very, very relevant. Learn all about the rules, learn all the rules of a method well and apply them every time. I think that's where most of us tend to give in. It's that every time, which is almost hardly, you just apply it whenever it's convenient to you.
Yeah, you apply it when it suits your view of the market. And when the chart says something else, you would like to give that particular rule a go by. I think one of the rules most flouted is the one which we have spoken about relating to divergence being coupled with a trend break. Now the minute people see divergence on a chart, everybody hollers it's all over, it's all over, and then they actually go and short it or long it. Now what they should do is take this rule into account which says that a divergence must be accompanied by a trend break. Without a trend break, the divergence is only a setup. It's not a trade signal, and then you will not really come to grief. So take the rule, apply it every single time, there is no exception.
Okay. Don't be dogmatic. The market talks and you listen. We've spoken about this on many of our shows, but it's the last one I think that I really like, and we'll see how it works out with our trade setup today, and that is when moving to a trade, stop being an analyst, and that's what we do all the time. And there are 4 words here that you'd love to explain this rule by, Doc. Just show it with the trade setup.
Yeah, I think this is something that I would want everybody to really look at and sort of appreciate on a chart. You know, that when we do an analysis, what we are really coming up is what should happen, right? So the first word everybody looks at is what should happen. I'm showing you a chart of Mahindra. Now I have various things put on it. This is typically what you would do when you're analyzing it. You have the price chart with the candlesticks and you have trend lines up there, resistance and support. Now this is something which is nicely at support, is waiting to break out of resistance. You also have a retracement there which says that it's pretty shallow, 38%, 50%. You have candlestick patterns showing hammer-like thing, lower shadows. Everything is in place, and you have also your RSI taking support and coming up. So this says that the market should go up. So this is something that you would look to buy as soon as the uptrend line is crossed, and this is where it gets crossed. And as soon as it crosses, you are going long, and you are going long at about 790, let's see. Now let's slightly go ahead and look. Here is what sort of really happened on the chart. And then you have this thing getting slammed down. So you shift immediately from shift to another word saying such and such thing won't happen. So he says the market won't go down now because now again it is traded down into support. This is a long range bar. You just start to justify it, right? And then we move along a little more and then you get it slammed down further. Now you come up with fresh justifications. And you say that, okay, we have traded down to the 61.8 and then you have a long shadow and there's a long range bar, big fall. Now it cannot go down further. So your should turn into won't and won't turn into can't. Now this is the way that we really think. Now look at what's happening. You are long at 791. Price is trading at about 691. You are $100 in the hole, right? And that is going to make you extremely nervous. Now you get a green candle and some follow-up and you think everything is over, right? Now the good times are going to come back and that is what is really keeping you in the trade. But then the good time stop coming back and then now you're trading down to 627 and you're really bleeding here and you're extremely nervous and your broker is calling you every day. Now at this stage you shift to one more word, you say the market must go up now. Why should it do something which is a must? Because you are in a hole and you really want that the money should come back. So you say it must go up. It will never happen. The market never does what it must do. It will do what it wants to do. So stop losses are a must. As soon as the basic point of your should has changed, just get out of the trade. Don't overanalyze. So when you are in a trade, stop being an analyst. Just be a trader.
Right. Analyze before the trade. If you were somewhere halfway down that downward price movement, maybe you would have initiated a fresh position.
Yes.
But because you started where you thought that the upward move is going to happen, you just get out of that trade.
And you just get pressured by the loss.
Well said, Doc. Okay, so those are the 5 commandments. Let's quickly get to our chart quiz today. Last week we'd asked you to analyze the Nifty and LNT, and here are the replies and the analysis that we picked for you.
Okay, thanks once again for all the mails that have been sent in. Lots of people have asked me to comment on all their mails. You have to realize that we have paucity of time. So even though if we want to address it also, it would be difficult because of the lack of time. So please bear with us. When and where possible, I will certainly look to cover it. For this week, very good analysis sent in by Ashik Abrar from Assam. Very detailed using daily, weekly, monthly charts. He's attached all of them well annotated in good detail. Wonderful usage of Fibonacci retracements, Ashik. I really like the way you really tied up the retracement situation in daily, weekly, monthly set of charts to arrive at the correct conclusion. Similarly, very good work done on the chart of LNT as well. I like the way you drew the conclusion and joined up the supports, the targets, the F and O expiry, everything nicely done. Very good work. I loved it. Please keep it up. I think most of the people have actually managed to get it right as far as the Nifty as well as LNT is concerned. But what I want to point out is that it's not about getting this one piece of analysis right. It's about creating a process of analysis. Once your process is right, then I think every time you will be on the side that which could be right more often than not. So please concentrate on the process of analysis. Just don't go at it, piecemeal, like a support is here or a resistance is here. In that context, I particularly want to mention about Anuradha Kumar's work. Very good work, Anuradha, very consistent in your work. But only thing that I would want to advise you is that you're far too conservative in your price targeting. You're doing a very good work, but I think when it comes to seeing the target, you're a little bit conservative. If you can improve that, it'll be so much better.
Time now for that special part of the show where we take you inside the mind of a trader. We do that every time, and here's today's no exception. Let's get inside the mind of a trader.
Well, I'm a technical trader, but I'm also a discretionary trader. So that means I look at a chart, I make a decision based on the chart, but then I may modify that decision from a purely technical perspective. I'm a discretionary trader, and that's what makes trading a skill and a craft rather than just an algorithm. The ability to make your capital work most effectively. If you put it into a house or an asset or something similar, there's all sorts of interfering factors that come in. But when you're investing directly in the market, it is the most efficient use of capital that you have. And also, there's the opportunity to match your mind with some of the best minds in the world and the best minds in the industry. It's an intellectual game first and foremost. They teach you humility. They teach you more about yourself, about your attitudes to greed and to fear than you really want to understand at times. So they are a very, very hard taskmaster. It's about human behaviour, your behaviour, that's expanded on a large scale in the market. If you understand yourself, then you can understand the behaviour of the market. Favourite books on trading? I have 2. First is George Soros, The Alchemy of Finance, and the second is the 36 Strategies. And the 36 Strategies because, seems unusual, because the market is about human behaviour, and the 36 Strategies are about human behaviour, how you recognise and how you use those to your advantage.
Well, with that, we've come to the end of this show. For next week on your chart quiz,